Welcome to Marion Street Capital's first how-to video. This is the first of a series of videos where we will aim to educate founders and executives on different strategic aspects of their companies so that they can get the most value out of their companies from different events and different turning points that companies face. For our first video, we're going to walk you through how to create a capitalization table for your price round. We are going to make this document available offline on our website, and I will include the link below. My name is Guevara, and I have worked with Marion Street Capital for 5 years. We have raised over $100 million in capital. We have helped founders negotiate their term sheets and understand their cap tables so that they understand how much they're going to be diluted after they have raised a target amount of capital. So let's get started with this tutorial. Some may be asking why it is important and critical to understand cap tables. There are a couple elements that I included in this document, but the main one for me is if a founder is able to understand the dynamics and the calculations and the math behind the cap table, the founder will be able to be in a strong negotiating position with investors to understand how much they will be diluted, how much the founder will get diluted, and how much of the company will be owned by the founder after the founder has raised all of the capital they need to grow their company and reach a liquidity event, whether it's an exit, a sale to another firm, or an IPO. The other big question that we tend to get is, well, I have Carta, why do I need to understand cap table dynamics and how to create a cap table from scratch? Well, it's like I'm saying here, garbage in, garbage out. If you don't understand what assumptions you're putting into your Carta software, Carta is going to give you whatever you put in. So for our clients, we always model out what the cap table will look like before we go in and input it in Carta and start collecting signatures from their board or from their investors. So these softwares are really helpful and they have a lot of educational resources. But being able to understand the core concept, how to create a cap table, how to model out a cap table, how to forecast your dilution is going to help you be in strong negotiating positions, as I mentioned earlier. We created a glossary. If you're not familiar with several of the terms that I'm speaking in this tutorial, you can access this document and you can learn and read what each of these terms I'm mentioning mean. So let's get on with our example. For this how-to video, we are going to simplify the creation of the cap table as much as possible. We're still going to add the level of complexity that we see in cap tables. As you can see here from the title of this video, we are working on creating a cap table for a price round. So you have heard safe notes, probably you have heard convertible notes. There are different dynamics for these types of instruments when you're raising for your company. At the moment, we're going to work on the price round, and on future demos and how-to videos, we will show you how to model out your safe note and your convertible notes. But for now, the price round is the most straightforward cap table calculation method. So let's begin with our assumptions. We're working with a SaaS company organized as a C Corp rather than an LLC. Usually investors are very familiar with C corporation laws in the United States, and because of that, several investors do prefer that companies are registered as C Corps. If you have another type of entity, I suggest you speak with legal counsel to provide investors intelligent reasons as to why you didn't register the company as a C Corp. It may come up during diligence questions or even the introductory call with an investor. We also assume here that the company authorized 10 million shares in its articles of incorporation. The company has two founders, each own half of the company, and the founders own 4 million each. So in total, they own 8 million shares. What that means is that there are 2 million shares that are authorized but still unissued. We will see how this plays out in the cap table scenario. Here, we assume that the company generates $500,000 in annual recurring revenue, and the company wants to raise a priced seed round at a $5 million pre-money valuation. That was a lot. What does a priced seed round at a $5 million pre-money valuation mean? Let's start with priced seed round. A priced seed round is basically, hey investor, I will give you a percentage of my company in exchange for money. There's no conversion terms, there's no complexities to the deal. It's rather simple. You pay me money, I issue shares for you. Now let's talk about this pre-money valuation in 5 million pre-money. So what we're saying here is, if you're raising $5 million pre-money valuation, it means that you as a founder are valuing your company and 100% of the stock of your company at $5 million. What this means is that you're putting a 10 times enterprise value to sales multiple on your annual recurring revenue. You can search what the EV to sales or enterprise value to sales multiple is, but it is basically a valuation metric that helps founders, investors, and finance professionals arrive at a rather simplistic way of valuing a company. Each industry has different medians, different averages for the sales multiple, on really depending on their company and their industry. And what we're seeing here is a 10 times on ARR. So that's why we're seeing, okay, for simplicity's sake, we're going to value this company at 5 million, which is a 10 times multiple on annual recurring revenue. Founders here are targeting an employee option pool of 15% post money. This tends to be a term that is strongly negotiated by founders or even by investors. And as a startup that is backed by a venture capital firm, or as a startup that is backed by investors, it is important to think about how you're going to compensate your early employees for growing the company. So let's get started with creating a pre-money cap table. It's relatively simple. Pre-money means before receiving investment. Another column that we will add here is fully diluted shares and percentage fully diluted ownership. What does fully diluted mean? It means that if you go through a liquidity event and you assume that all the options are granted and all of the convertible shares are converted for that liquidity event, this is what the true ownership of the company will look like. Because these are hard-coded numbers, I'm going to paint them in blue. Then we have total outstanding ownership, or total outstanding shares. And we will simply calculate. This is the simplest exercise there is, right? Creating a cap table before investment. We already know what it looks like. They have the same amount of fully diluted shares. They don't own options or anything like that, or any form of convertible instrument. So the fully diluted ownership. Now, if you remember the assumptions, we mentioned that the company authorized 10 million shares in its articles of incorporation. So why are we seeing 8 million here? Well, 8 million are outstanding, but there are 10 million authorized. So what does that mean? So we're going to write authorized, not outstanding shares here. And we know that that's 2 million shares. As you can see, even if these shares are authorized but haven't been granted to the founders, they are not part of the makeup of the company ownership. This is an important distinction to make as well. Now here we have our finalized pre-money cap table. This is basically the modeling of what the assumptions look like, right? Now we're going to go into creating our post-money cap table. I'm going to start with the same columns. We mentioned options, so we're going to write options outstanding. Okay. Now we have this. We know that we have two founders. Each of them own. It's the same thing as we saw in the last cap table. So what I'm going to do is I'm going to copy this over. Outstanding shares. Okay. Now we have the investors. Let's assume that we have 3 investors that put money into the company. Let's put investor number 2 and investor number 3. On top of that, we will also add the assumptions so that we can easily reference them as we are creating our cap table. Our target capital raise, let's say that the founders want to raise $1 million. SaaS valuation multiple, we indicated we wanted 10 times. Enterprise value to sales multiple, painted in blue. So what's my pre-money valuation? If as a founder I'm valuing my ARR at 10 times, my sales multiple at 10 times, it is basically this multiplication, and this will give us the pre-money valuation that we indicated in the assumptions. Our post-money valuation then is our pre-money plus whatever amount of capital we are trying to raise. In this case, 1 million. So our post-money valuation is $6 million. The last element here that we mentioned in the assumptions is this option pool of 15%. So what we're going to do here is we're going to hard code this 15%. Let's assume that the first investor puts 500,000 and the remaining 2 investors put 250,000. These are hard-coded numbers. These are numbers that are already agreed upon, or that you hope you agree upon with these investors. So these are hard-coded in blue. I have a total column here where we're going to add this. We're going to sum the number of shares outstanding, options outstanding, total outstanding shares, which is basically, well, we're going to add these up as well. Percentage outstanding should be a sum of all of these. Same for these two. So we know that the founders used to own 50% of the company, but now with these additional investors in here, we know that it's going to be lower than 50% each. So let's begin working with what we know. We know that this investor is buying $500,000, is investing $500,000 to buy stock in the company, to buy shares. Now, a common mistake we see is that some founders or some people who are not very familiar with cap tables use the pre-money valuation to arrive at the percentage of outstanding. But remember that this is a pro forma cap table. We're trying to model out what ownership will look like after we have raised the capital. And as such, we are going to divide the 500,000 over the post-money valuation, not the pre-money. Now we know how much each investor is going to own after putting the money in. Here's where the typical big mistake comes in when working through this. Circular references are a really big component of cap tables we have seen over the past years when we have raised capital for our clients. Some people are okay working with circular references, but we believe that math always has a way of showing us how to create a cap table without using circular references and having broken spreadsheets. This is what we're going to do. So the simple exercise would be, okay, we know that we have 8 million shares, right? And we multiply it by this outstanding, and that should give me the number. Well, as you can see, we'll have a circular reference because this total is counting this cell E7. And because of that, we cannot use this method to create a cap table. So what we are going to do now is edit this formula. Let's get rid of this. We're going to edit this formula to not count these three cells. At this point, we just want to figure out what is going to be the total amount of shares that are going to be outstanding with, when you count these 8 million plus these percentages that the investors will own. So what we will do here is we will create this formula. And now with this, we know that the total amount of shares that will be outstanding after closing the round will be 9,600,000 shares. And then it becomes easy to multiply the total by the outstanding. Don't forget to lock in the cells when dragging down, and there you go. So now we will calculate the total outstanding shares. In this agreement, nobody will be granted options. We will just authorize a pool of options of 15%. Now that we have this, we can calculate what our outstanding percentage is for the founders. This is what the founders will own outstanding after the round is closed. The best way you can verify that this is correct is by making sure that this adds up to 100%. Now let's talk about the options pool, right? So we're going to create a new row called options, option pool, unissued. Basically, all of the options that were authorized but not issued. As I mentioned before, they will not be part of the outstanding shares because they have been unissued, so they are not outstanding. They're just authorized. However, we can now go into our fully diluted shares, and as I mentioned earlier in this video, fully diluted ownership means what if everything is exercised, all the options are exercised, what's going to be the makeup of the ownership of the company? So options in this case, in fully diluted terms, are going to be counted in the ownership of the company. So we will just reference this 15% of the option pool. We know that the options need to be 15%. We know that there's 0% here. Because there aren't other instruments, it's very simple to know that the fully diluted shares that the investors and the founders will own are the same. What changes here is this number, the total amount of fully diluted shares. Why is that? Well, because we authorized 15% in options. So what we will do here is edit this formula to remove this cell from the sum. We were going to do the same exact formula we used to create the first portion that prevented circular references. So we know that the total amount of shares that will be owned by the company, that will be owned fully diluted, are 11.2 million shares. And then it becomes simple to just arrive at the final number. And then we do the same. And lastly here, we will just, forgot to drag this down one cell. And there you have it. It's our final cap table when we assumed that we are going to raise $1 million for this company. So as you can see, the fully diluted ownership here is smaller because there's an additional 15% of the company that has been allocated to options. Remember that fully diluted assumes that if every single instrument is exercised, what would be the ownership for the investors and founders in the cap table? Well, this is what it looks like. Now we know what our cap table will look like after we raise $1 million. I hope this tutorial was helpful to you. As I mentioned at the beginning of the video, I will make this document available on our website. So click the link below in the description and you will be able to download the document. You can play with the numbers, you can play with the assumptions. That's why we wrote them down here, so that you can play with assumptions and you can understand what changing, if you wanted to change something, what would it mean for the cap table and for the ownership structure. I hope this was helpful. Thank you.